Greetings and welcome to the session. The subject is Advanced Financial Management. Today we are moving to a new topic known as Corporate Restructuring and Reorganization, which has 12 subtopics. The first one being background on restructuring and reorganization. Number 2, symptoms of restructuring. Number 3, causes of financial distress. 4, forms of financial distress and solutions to financial distress. 5, considerations in designing an appropriate restructuring program. Number 6, financial reconstruction. Number 7, portfolio reconstruction. Number 8, the relevance of the various forms of portfolio reconstruction. Number 9, organizational reconstruction. Number 10, other forms of restructuring. Number 11, restructuring in the public sector. And lastly, models of predicting corporate failure. These are 12 subtopics. We'll be taking each subtopic at a time. Today we are beginning with the background on restructuring and reorganization. Background on restructuring and reorganization. So from the word structuring, we get restructuring. From the word organization, we get the word reorganization. So these are two terms, and the terms involve significant purposeful changes to a company's corporate structure, also including finances and operations. When a company engages in purposeful changes to its corporate structure and finances and operations, we say the company is restructuring and reorganizing itself. And the reason why a company would do that is to improve efficiency, to improve profitability, and also the overall competitiveness. Now, these are two terms which are generally, or in most cases, used interchangeably, but they both describe a process aimed at aligning the business with its strategic goals, and in most cases, often that is done in response to either internal challenges or external market pressures. So a company may reorganize, a company may restructure itself due to factors beyond its control or because of internal considerations. So corporate restructuring, to begin with, is a broader term that covers a variety of actions designed to strengthen a company's financial standing and enhance its performance. That is corporate restructuring. And these changes are usually undertaken when a company is facing major financial distress or seeking to capitalize on new market opportunity, or just integrating two or more businesses. When a company wants to integrate two or more businesses, then restructuring may take place. You understand? Now, the main goal of restructuring is always to create value for the company and also its shareholders. And there are various objectives. Let's get into some of the objectives of restructuring. Primary objectives. What are the primary of corporate restructuring? Now, the first one, which I mentioned, is improving efficiency. Is to improve. A company will restructure itself in order to improve efficiency. That means that by streamlining processes and also reducing unnecessary layers of management and cutting redundant operations, that can in itself improve efficiency and reduce operating costs. So the company may undergo corporate restructuring in order to improve efficiency. Number 2, enhance financial Corporate restructuring may be necessary in order to enhance financial stability of a company. It could involve negotiating better debt terms. It could involve raising new capital or selling off assets to reduce debt and improve cash flow and so on. So in the process of restructuring, a company may sell off some of its redundant assets and get some money to improve its financial stability. 3. Focusing on core business. This is another objective of restructuring, to focus on a company's core objectives, core business. All right? By, say, divesting non-core or unprofitable operations or assets or segments. The company may decide to do away with certain segments, with certain divisions, or even branches, so that it can concentrate on its core business. All right? And that in itself helps the company to concentrate resources on the most valuable parts of the business. So focusing on core business is a primary objective of corporate restructuring. 4. Adapting to market changes. Restructuring may help a company to adapt to market changes, aligning the company's structure and strategy to respond to shifts in consumer behavior, to shifts in technology, or even the competitive landscape. A company may restructure in order to adapt to market changes. These are external factors in order to compete. A company may need to restructure, all right, to fit into the competitive landscape. So these are 4 primary objectives of corporate restructuring: to improve efficiency, number 1; number 2, to enhance financial stability; number 3, to focus on core business; number 4, to adapt to market changes. Very important points there to note. And kindly don't forget, we are studying corporate restructuring and reorganization. Corporate restructuring and reorganization. Now, I want us to briefly, before we close this short session, I want us to distinguish corporate restructuring from corporate reorganization. What's the difference between these two terms? Now, we are going to distinguish these 2 terms, first of all, on the basis of, we'll have the basis for distinction. Let me have it in columns. Basis for distinction. Now, the first basis for distinction is the scope. How do we distinguish corporate restructuring from corporate reorganization? Based on the scope. So let's have 2 columns here. We have restructuring, reorganization. Now, what is the scope of restructuring? Now, restructuring, as I said earlier, is a broader term that encompasses many things. So corporate restructuring is, first of all, major. It is major. It is fundamental. Corporate restructuring, it is wider. It's fundamental. It is far-reaching. The scope is far-reaching. That is to mean that it affects the entire corporate entity. It affects its financial health. It affects its legal structure, and so on. When restructuring is done, it's fundamental. It is far-reaching as compared to reorganization, which is smaller. The scope here is smaller. The scope of reorganization is narrow. It is smaller. It is mostly internal. If you have to compare the two, this one is broad, the organization is narrow. Okay, it affects the internal hierarchy it affects departments. Reorganization affects the workflows. But restructuring is major, it is fundamental, it's far-reaching. So that's the first distinction between corporate structure and reorganization. Now, the second distinction is based on the focus. What is the focus of restructuring? Now, the focus of restructuring is, first of all, financial. This focus here is financial. It may also be strategic, means long-term. Financial. The focus, it focuses on the financial aspect. It focuses on the strategic direction that the company would want to take. It deals with the capital structure or the portfolio of assets and business units. Whereas reorganization is operational. The focus of reorganization is just on the operations of the entity. That's why we said it is smaller, it is internal, it affects the departments and workflows. It deals with reporting lines, job roles, it deals with business processes within the context of this structure. So that's the second distinction between corporate structure and corporate reorganization. The third difference is based on the triggers. Triggers. What triggers restructuring? What triggers reorganization? What is it that triggers restructuring? That's the first point you want to note. Restructuring, given that is major and fundamental, given that is financial and strategic, it may be triggered by severe financial distress. Severe financial distress. It may be triggered by severe financial distress. It may be triggered by a major merger and acquisition, all right, because it is major. Okay, it may be triggered by a major merger where the two companies are coming together, or where the company is acquiring another one. That can trigger restructuring. The company may need to do a restructuring. Or it may just be due to a major overall strategic overhaul. So that's restructuring. On the other hand, candidates, reorganization may be triggered by need for increased efficiency. It may be triggered by need for increased efficiency. Maybe the company wants to increase its efficiency. It may need to reorganize its operations and so on. So the need for efficiency may trigger reorganization, or just cost. It may be need to reduce cost. Cost reduction can trigger reorganization. The need for efficiency, it may also be as a result of need for better communication. Better communication can trigger reorganization because we said it is internal, it is smaller in scope, it is operations. Here we are dealing with operational issues. So that's the third distinction between restructuring and reorganization. The third distinction may be based on the methods. You can distinguish these two based on the methods that are or techniques that are applied or used when restructuring or reorganizing. Okay. Now, one method for corporate structuring is debt for equity swaps. The company may use debt swaps because we are dealing with the overhauling the financial the company's capital structure. They may need to sell a division or even spin-offs. We may have methods like spin-offs, which we'll be discussing later on in this topic. We'll be looking at spin-offs, things like strategic alliances, sell-offs, divestments. Those are methods that may be used when restructuring a company. We'll get into the details as we progress in our lesson. Okay, filing for bankruptcy protection and so on. So those are some of the methods for restructuring an organization. And the methods for reorganization may be merging departments. For example, merging departments can be a method, because remember we said the scope is internal, the focus is on operations. So by merging departments, a company would be reorganizing itself. It could also be flattening the management structure. I mean the management hierarchy. Flattening management hierarchy, where the management has many lines. Because we know we have the flat structure. Management can flatten the structure. If there are many layers, management layers, the company can flatten so that there is only one or few reporting lines. You understand? Flattening the management hierarchy, or just redefining job descriptions. Redefining can be another way or method of organizing. Redefining job descriptions. So we may distinguish restructuring and reorganizing based on the methods that are used when restructuring. What are the methods that you use when reorganizing a company? There are many methods, adopting new technology and so on. So that's all candidates for today's lesson on corporate restructuring and reorganization. This is the first lesson. There are many other lessons we are going to attend to be covering. We've identified 12 areas. This is just the first one, which is the background. Today we're just laying the background of corporate restructuring and reorganization. In this lesson, we have identified the objectives of the primary objectives of reorganizing and restructuring, and also the distinction between the two. Thank you for attending the lesson. Bye-bye.